Welcome, my favorite federal employees. I'm Andrew McNair, son of a CSRS employee and founder of Sleep Well at Night Capital, Swan Capital. And we're a total wealth management company with a CPA, estate planning attorney, and financial planners all under one roof, serving federal employees just like you every day. So let's jump right into today's very important topic.
Yeah, let's do. And a good place to begin, Andrew, is at the top. So, what is FEHB and why should a federal employee really care so much about it?
Yeah, I mean, it's the federal government's health insurance program, which is a generous employer cost share of your premium. And it's really an amazing benefit that you have as a federal employee. And I know it's been a tough, feels like 2 years or longer of being a federal employee, but you have some really good benefits and you can typically keep FEHB into retirement if you meet the rules. And this is one of the most valuable retiree benefits you need to have is your health care coverage. So because costs and coverage do change yearly, choosing the right plan can save you thousands in total annual costs.
Who wouldn't want that? Saving thousands. All right. So can I keep FEHB when I retire, and are there any rules I need to be aware of?
Yes. If you retire on an immediate annuity and were rolled in FEHB, and that was for 5 years before your retirement or at your first opportunity, if less than 5 years, the good news is, yes, you'll be covered under FEHB, and the government cost share continues in retirement. You still pay your share, and so this is a really amazing benefit. Now, keep in mind, for survivor benefit planning, if you want your spouse to keep FEHB after you pass, you generally must elect a survivor annuity at retirement and keep family or self+1 coverage to make sure that they're covered.
Is there a smartest way, if you will, to compare FEHB plans?
Yeah, I would say don't just compare premiums. I would look at the total annual cost. That's premiums plus expected out-of-pocket costs. And so you want to use a comparison tool to model good, average, bad year costs. And it's common to see a $2,000 to $5,000 difference. And so I would confirm the out-of-pocket max, and that's your worst case exposure if this year were to go sideways for you health-wise. And this is why it's important to go to all your checkups and make sure that if the coast is clear, that affects your choices with your health benefits. But if you foresee some things that are going to be needed in the future for your health, then please address it correctly with your benefits in open enrollment.
All right, so, we're really good at the alphabet soup here in the United States. Plan types do confuse people. I mean, we have HMO, we have PPO, we have HDHP.
Yeah. It can get
should
confusing.
consider what?
Yeah, it can be very confusing. So HDHP, so that's your high deductible health plan, plus HSA. So I'm a big fan of an HSA because it's one of the 5 tax-free investments. You actually get a tax deduction. The money grows tax-free, and you can take it out tax-free. It does mean lower premiums, and a tax-favored HSA is great for really healthy savers who can cash flow, and they only need routine care, and they're doing all the proactive things to make sure that they're staying healthy. Now, a PPO is broader networks and out-of-area flexibility. That's often better for frequent travelers or families that are spread across multiple different states. You're traveling among many different states, you might want a PPO. Now, an HMO usually is lower out-of-pocket for in-area care. So if you're going to stay at home a lot, you already have your doctors picked out. It's good if your doctors and hospitals are already in network and you're going to stay mostly local. So the rule of thumb is if you travel a lot, or if you have kids that are out of state that you may be traveling to go see, I would lean towards a PPO. If you're local with stable in-network, doctors, an HMO can pencil out a lot better.
Yeah, it makes sense. So let's say I want to switch plans. Is there something that I should check first?
Yeah, of course. I would check your doctors. I mean, I'd verify that your providers are in network for the new plan and at your preferred hospital, of course. Next is prescriptions. Before I leave that, the last thing you want, Bruce, is you to be like, I'm in a health crisis, and tell the ambulance driver, I need you to go to that hospital instead. So it's good to make sure that you've picked appropriately the hospital near you. Next, prescriptions. check the plan's formula and tiers for your exact meds and dosages. This is really important to meet with your pharmacist if you need to, and make sure that you have all of the meds that you take and how that's going to apply with your coverages. Also think through referrals and authorizations. Some plans require them, and you need to know the rules so that care isn't delayed or costs a lot more than you expect. And then extras. Think about dental, vision, the integration there, telehealth, how's that work? What happens if I'm doing a lot of international travel? How is that going to play into my coverage?
All right, let's talk for those who are watching us today and they're 65 or older, they've started Medicare. How does FEHB interact with Medicare?
So many retirees enroll in a Medicare Part A at 65. Usually that's, of course, going to cost you nothing, and then decide on Part B based on use cases, their budget, and the plan design. So with Part A and Part B, FEHB often becomes the secondary while Medicare is the primary. So that reduces those copays, the deductibles, because remember, Medicare was not designed to cover 100% of your coverage of your cost of healthcare. It was only designed to be 80%, so the FEHB is going to pick up the other. So some FEHB plans offer Medicare Advantage options or Plan B incentives, and that varies by the year, the plan, and so you really need to check into the details here. The other thing you need to be aware of is IRMAA. Part B and Part D premiums can increase because of higher income. So if you have a home sale, you're selling a rental property, you and your spouse are both working in the same year, you're taking out money out of your TSP or IRA, all of that can go into your IRMAA surcharges that can really add up to where you're paying $300, $400, $500 a month in Medicare premiums per person. So bottom line, please compare your FEHB only costs versus FEHB plus Medicare costs, including the premiums, the out-of-pockets, and any incentives.
All right, Andrew, I've listened to your radio show. I know I've watched videos that you have on. I know you're tax savvy. So HSA and FSA, how do these tax pieces fit within FEHB?
Yeah, this is really confusing. So my dad, growing up as a CSRS employee, we always use the FSA. We're always getting braces at the end of the year. We're always thinking about the health that, we need to use up these costs. Well, HSA doesn't work that way. So HSA with an HDHP, a high deductible health plan, is a triple tax advantage account. So there's annual limits. You can't just put everything you want into the HSA, but it reduces your taxes because it's considered a tax deduction. It can grow tax deferred. You can invest the money, and it is actually taken out tax-free. It's amazing. In the HSA, you can use it for hundreds of items. And so if you have an HSA, you pair it with a limited purpose FSA, like for dental and vision only, not a full healthcare FSA. Again, full FSA is completely different where you have to spend the money. HSAs are not the case. Now, with FSA Feds, it's great for predictable expenses, but remember, you must re-enroll every open season. So just watch that double dip rules. You don't want to have that issue where you don't get a reimbursement with the same expenses from both accounts.
All right, so let's say I change my FEHB plan. And what if life changes mid-year?
Yeah, life changes can absolutely, they don't just plan around open season when you have health situations. So open season is typically mid-November to mid-December each year, and the exact dates do vary. So qualifying life events, so QLEs for short, like marriage, divorce, birth, adoption, certain moves or losses of other coverage can actually allow for mid-year changes. So keep an eye out for those, but retirees can generally switch plans only during open season, just like active employees.
You talked earlier about people that want to travel in retirement, and again, that's great, and as long as you've got a plan for it. But we've got a lot of travelers that tune into these your social channels. How does out-of-area care work for those folks?
Yeah, it's a big deal to make sure that you don't skimp on insurance when traveling abroad, because a travel insurance policy can help in more ways than one, especially like medical emergencies, or maybe you want to come back for the surgery that you're thinking about having over there in Europe. Even if it's covered, you may want your own doctors doing that surgery. So emergencies are typically covered everywhere, but definitely see the details. But routine out-of-area care is where where the differences definitely show. If you want to pay for you to be shipped back to the United States, that can vary very differently, and that's why we often recommend travel insurance. Now, what about HMOs? They often limit routine care to the service area, so PPOs usually have national networks and better out-of-area access. So if you winter, maybe in another state, you plan to be a snowbird and you plan to go overseas, you need to confirm the plan's urgent care and international claims process and be well aware of how it works.
You know, people understand, I think, that obviously you have a great background in this. And so are there some common mistakes or expensive mistakes that you've seen over the years?
Certainly. So I would say choosing premium only and ignoring the deductible, the coinsurance, and the out-of-pocket max is one of those things where people say, I just want to save money. It's like, well, you may be costing yourself money in the long run. I would say not verifying doctors and medications before switching. How sad to have to switch to different doctors that you don't have a long-term history with because you've chose the wrong plan. Forgetting about FSA and re-enrollment each year, ignoring Medicare coordination at 65 and potentially the IRMAA impact of your distributions from your TSP. And then I would say staying in a plan that was perfect 5 years ago and assuming that that's always going to be the best plan, but not for next year's needs like a surgery, new prescriptions, travel, or new dependents.
You know, again, you're a thought leader when it comes to these plans. And so decision trees can kind of help people. Do you have a decision tree that you can provide folks watching this and that would help them in some of what they're trying to learn today?
Yeah, certainly. So if you say, I want the lowest predictable costs and my docs are local, well, I would consider an HMO. If I travel often, I have kids out of state, and I want the flexibility, I would consider a national PPO. If I'm healthy and I'm a strong saver and I'm comfortable with the higher deductibles and I feel like long-term me and my spouse's health is going to be healthy, I would definitely go the route of an ADHP with an HSA. Now, if I'm 65 plus and I'm comparing Medicare prices, FEHB only versus FEHB plus Medicare, I would be factoring all of the incentives and the IRMAA penalties that may lie ahead. If you have a big medical year ahead, procedure like maternity, specialty drugs, things like that, depending on where you are in your career, you want to model total annual cost, and your best plan can change year to year. The key, because we work with so many retirees, is make sure that you get that full physical, that full medical workup before you retire, because this should impact the decisions that you make alongside FEHB, FEGLI, and FEHB.
Yeah, those who are nearing retirement, be more like me, knee replacement, hip replacement, those would be a big thing in a year. All right, I know you have a checklist. Can you provide a little checklist here for folks as we wind down this video?
Yeah, if you're taking notes, I would say number one is pull the last 12 months of claims, list doctors and prescriptions, and make sure that that aligns with your options. Number two, I would shortlist 2 or 3 plans and compare the total annual cost, not just premiums. Number 3, I would confirm network and formulary, note all the out-of-pocket maxes and the referral rules. Next, I would decide on HSA versus FSA. I would also think if I'm 65, I would run a Medicare coordination comparison. This is why we have a Medicare specialist, a part of our team, and I would be rechecking annually during open season as a retiree. So if you want a second set of eyes on your FEHB options, you want a second set of eyes on your FEGLI, as well as your survivor benefit options, before you choose all of these options when you're going to file for retirement, please take us up on our complimentary personalized federal benefit report that we prepare for families every day. And so we would love to do one for you. All you have to do is click the link below to schedule that visit or call the number in the description. And I hope you have a blessed day, and we'll see you next time.